Hello and welcome to FT Markets. Today the topic is China, and we're going to try and take a bit of a bigger picture look at what's going on in the world's second largest economy and some of the linkages with the rest of the world. Trade, finance, commodities. To help us do that, today we're joined by George Magnus, Associate at the China Centre of Oxford University and Senior Economic Advisor to UBS. Hello George, thanks for joining us.
Thank you.
And so perhaps I think we've got a chart here we can start with. But in broad terms, I think what you're saying is GDP perhaps isn't the best way to think about what's happening in China and its effects.
No, it doesn't really tell us anything. I mean, even if we believe the GDP numbers that the government publishes, I mean, the fact that GDP may slip or slide by X or Y% over the course of a 12-month period doesn't really tell you anything other than a mathematical composition of what's going on in the world. What we really need to do is look at the transmission mechanisms by which China has an impact on other countries.
One of the important ones of these, obviously, is sort of the commodities, and that also leads us into trade relationships.
Yes, commodities are really important because we've kind of salivated, and investors have salivated over the last 10 or 15 years that China accounts for 40% of global consumption of nickel and aluminium and zinc and copper and so on. And of course, what was fantastic on the kind of the bull market ride in commodity markets, of course, is now being fully reversed because the commodity composition of China's growth is now falling quite substantially as the investment rate, particularly in real estate and construction, drops.
That sort of super cycle we've heard so much about, it was so great on the way up and now it's turning into reverse.
Yes, that commodity cycle. I mean, ultimately, one imagines that once capital spending in commodity companies and commodity countries has been squeezed hard enough that actually maybe there'll be some pricing power will come back. But that's not going to happen for a while. And the China impact on commodity markets and on commodity volumes and prices from Perth to Peru, is going to be with us, I think, for some time. It's quite painful for those countries and sectors that are very reliant on commodities.
But what about the broader trade linkages? I mean, as we're thinking about the rest of the world and the effect if China slows down, so what might be the consequences for sort of major trading partners that we should consider?
The impact is quite varied, but I don't think it's as substantial as the China is collapsing kind of mantra that was going around in markets back in August and early September. Because as the chart shows, I mean, there are some countries, Hong Kong, for example, which is very exposed to slowdown in China. Some sub-Saharan Africa countries, Angola, South Africa, Democratic Republic of Congo, for example, are very exposed. Latin America, Brazil, Peru, Chile. I mean, all of these countries actually do have a lot to lose. I don't think the developed world, the United States, Japan, the Eurozone or EU are as vulnerable, even though some companies that rely on selling automobiles or luxury goods to China, of course, are feeling the pinch.
Yeah, so we can sort of see the tail of the developed world down at the bottom there as sort of pretty minimal trade exposures in terms of the size of the economy.
Yes, it is quite small.
But what about the financial links then? I think we've got another chart here in terms of some of the financial exposures to sort of Asia and the Pacific, particularly China.
Yes, now this is quite interesting because it shows from 2007 to 2015 a probable doubling, really, of international banks' exposure to Asia Pacific in general. But a lot of that exposure is China. The lending to China by global banks went up sixfold between 2007 and 2015. And what it also shows is that the share of European banks has basically shrunk very, very substantially. It doesn't show the share, but the share has gone from about a third to about 14%. And most of that shrinkage has been made good by banks in Hong Kong, Singapore in the main, but also Chinese banks too. So vulnerability to the Chinese slowdown, to the coming surge in non-performing loans, which may take a while to come through because there are institutional blockages to recognition of bad debts in China. But we have to keep an eye on those financial transmissions too.
And I guess that brings us to sort of the broader Chinese question, which is where are we then in the pace of reform, growth, and sort of recognising these problems in China? What is your sense of what is happening?
Well, I think the slowdown in China is, in its many manifestations, actually is causing quite a lot of problems, as you can imagine, to policymakers at a time when they're trying to reform in many ways, but actually in some respects failing to do so as well. So it looks to me, especially given the 13th five-year plan, which this gentleman has presided over just recently, that they've actually opted to go for growth rather than reform. And the sad news is actually that by doing so, they may end up with little reform and much lower growth too.
Great. Well, thank you very much, George.
Thank you.
As he says, China is trying to maintain its growth, but also reform its economy. The problem is, as it tries to do that, it risks ending up with neither.